Compliance is the word that terrifies more new mortgage brokers than any other word. It sounds heavy, it sounds legal, and it sounds like the kind of thing that could end a career if you get it wrong. And in fairness, it actually can. But here's the honest truth, almost nobody explains properly at the start. Compliance in mortgage brokering is not complicated. It's just a set of habits done consistently to protect your clients, and more importantly, they protect you. Master the habits and compliance stops becoming something you fear and becomes the thing that makes you a better broker. See, here's why this matters and why I want you to actually pay attention to this one. New brokers who get compliance wrong, they don't just get told off. They get their files pulled, they get put on remedial supervision, and their firms lose trust in them. Worst case, they even lose authorization, which effectively is going to end their career. And the ones who don't get caught in year one, they still pay the hidden cost because sloppy compliance habits built early become the habits you carry for a decade. And eventually, one of them will catch up with you. The FCA isn't out to trap new brokers, but it is watching, it is auditing, and it is holding advisors to a higher standard now than at any other point in the last 20 years. Getting this right early isn't optimal, it's how you protect the career you are starting to build. So let's clear up what compliance really means, because most beginners, they walk into this thinking it's some sort of vague, terrifying legal thing they have to somehow learn. And it isn't, okay? Compliance is the framework that makes sure the advice you're giving is genuinely suitable for the client that you're giving it to, and that you can prove it later, and that the client understands what they're taking on. That is the whole game. Everything else, the FCA, the consumer duty, suitability letters, file checks, vulnerability rules, it is just the machinery around that one single idea. If you can explain why you gave this advice you gave, why it suited the client's actual situation, and what the client understood when they signed off on it, you're already 90% of the way to being a compliant broker. Compliance isn't a subject you memorize, it's a way of running cases that leaves a clean trail behind you. See, sitting behind all of this is the Financial Conduct Authority, or the FCA, which regulates the entire UK financial services industry, including mortgage advisors within that. Now, most new brokers won't ever deal with the FCA directly because you'll work under a network as an appointed representative or even inside an employed firm, and the FCA regulates the firm rather than every single individual advisor inside it. Now, the firm holds the authorization, the firm carries the compliance responsibility, and you sit inside that structure. That's the part of why picking the right network or the right firm matters so much, because their compliance standards are effectively going to become your compliance standards. So if you're inside a good firm with proper file checks and structured supervision, you'll build really good habits by default. If you're inside a firm that's slack about it, you're going to build lazy habits without realizing, and lazy habits are what catches brokers out 3 years down the line. The single biggest shift in broker compliance over the last few years is what is called consumer duty. Now, if you've heard the phrase and thought it sounded vague or corporate, you are not wrong in this one, okay? It is vague deliberately because it is an outcome-based rule rather than a rule book. But in plain English, consumer duty says 4 things. Firstly, your advice has to result in good outcomes for the client, not just technically compliant ones. Secondly, the client has to genuinely understand what they're taking on, not just have signed a document saying they do. Thirdly, the product has to actually suit the client's real needs, not just the ones you told them about on your first phone call. And fourthly, the price has to represent fair value. That's consumer duty in a paragraph. What it means practically is that the regulator has moved from asking, did you follow the rules, to asking, did the client end up better off? And that shift is the thing driving nearly every single compliance conversation in this industry right now, particularly around protection. Because a broker who places a mortgage without properly protecting the client's income and family against foreseeable harm is arguably not delivering a good outcome, even if every single piece of paperwork is technically in order. That's the tension. And it's the reason I bang on so much about protection being part of the advice, not a bolt-on afterthought. Underneath consumer duty sits the single most important document in any broker's file, and that's called a suitability letter, sometimes called a reasons why letter or the demands and needs statement. Depending on the firm you're in, that's kind of the names just differ. But it's the document that explains in writing why the broker recommended what they recommended. Why this lender, why this product, why this term, why this level of protection cover, why this loan to value, why not the alternatives. It's the paper trail that proves the advice was thought through, personalized, and was genuinely suited to that specific client. And most modern CRMs generate the bulk of the suitability letters automatically from that fact find. Your job as a broker isn't to write it from scratch, it's to make sure the reasoning inside it is genuinely tailored to that client, not some generic copy and paste language from the CRM, because that's a specific thing that gets pulled apart at an audit. Generic suitability letters that could apply to anyone are the single most common compliance flag on a new broker file. Personalized reasoning that clearly ties the recommendation to the client's actual circumstances is what proper compliance looks like on paper. Now, how does anyone find out whether your files are up to scratch? Through file checks. Every regulated firm runs file checks. It's the mechanism that catches problems before they turn into compliance or regulatory issues. And in a good firm, a percentage of your cases gets pulled every single month by a compliance officer or a senior broker who reads them cover to cover. The fact find, the suitability letter, the research notes, the recommendations, the protection conversation, the sign off. They're looking for gaps in the reasoning, missing evidence, weak suitability logic, and protection not properly addressed, and anything that suggests the advice really wasn't fully considered. Now, for a new broker, every single case usually gets checked before it can even be submitted. That's what competent advisor status is really measuring, whether you can consistently produce cases that pass that file check without any issues. Once you've got CAS, those check frequencies drop, but it never disappears. Even senior brokers will have a percentage of their files audited regularly. That's how the system works, and it's why the habits you build in year one matter so much, because they're not just doing the case for the client, you're doing it for the person who's going to read it 3 months later. Now, one of the areas that the FCA has genuinely tightened in recent years is vulnerability. A vulnerable customer isn't just someone who's obviously struggling. It's a much broader category than most new brokers realize. It includes clients dealing with recent bereavements, mental health issues, physical illness, financial stress, low financial literacy, non-English first language, elderly clients who might struggle to understand complex products, clients going through a divorce, or anyone whose circumstances may make them more susceptible to harm from a wrong decision. Now, the rule isn't that you can't help vulnerable customers. Of course you can. And often they're the ones who need the brokers the most. The rule is that you have to identify vulnerability, document it, adapt how you communicate, and take extra care to make sure they understand what they're taking on. Some brokers, they panic when they hear this and they think it means just more paperwork for every single case they do, but it doesn't. What it means is that during your fact find, you should be listening for vulnerability signals, and when you spot them, you flag them in the file and adjust your process accordingly. Slower conversations, simpler explanations, checking understanding at every stage, sometimes just bringing in a trusted family member with the client's permission. Handle vulnerable customers well, and you will be one of the most valued brokers in your area. Handle them badly, and you are just one complaint away from a really serious problem. Now, the next question is, what actually happens if you fail on compliance? Well, the honest answer is, it depends how badly you actually have got it wrong. Small stuff, so like a missing signature, a weak piece of suitability reasoning, a fact find that's not detailed enough, that just gets flagged, you fix it, you move on, okay? But bigger stuff, patterns of poor advice, repeated failures on the same issues, evidence that you're not really thinking cases through, gets escalated, and it can usually go onto remedial supervision, meaning that every case gets checked again before submission until the firm's satisfied you're back on track. Now the serious end, okay? This is the advice that's actively harming a client. Misrepresentation, deliberate rule breaking. This can end in deauthorization, which effectively ends your broker career. That third category is genuinely rare and almost always involves a broker who's been giving multiple warnings and just keeps ignoring them. Nobody ever accidentally gets deauthorized. The people who do usually have been told repeatedly and they choose not to act on it. The mistake I often hear new brokers make on compliance are almost always the same handful. First, treating the fact find as a form to complete rather than a genuine information gathering exercise. So your reasoning underneath the recommendation ends up being shallow. Second is copy and pasting suitability language from previous cases, so the letter reads generic instead of some sort of specific situation to the clients. Third is leaving protection either off the file entirely or handled so lightly the file checker can't see how the client was properly informed about their options. Fourth one as well is not documenting the way of decisions. So a case that was probably absolutely fine doesn't look good or is completely unexplainable to anybody reading it. And the fifth is missing signals of vulnerability because they weren't looking for them. Almost every compliance issue new brokers face traces back to one of those 5 things. Fix them early, build the discipline into your case flow now, and the compliance stops being a threat and it starts just becoming a background hum. Now, a question that I do get from new ambitious brokers is whether they'll need their own compliance officer, particularly if they're planning to go self-employed. And the short answer is no, not for a long time. When you're working as an appointed representative under a network, the network's going to provide your compliance functions. That's what part of your commission split is paying for. Their compliance officers handle audits, file checks, regulatory updates, and the ongoing relationship with the FCA. It's only if or when you go directly authorized, meaning that you will become your own regulated firm rather than sitting under a network, that you need your own internal compliance functions. That's usually years down the line. And at that point, when you've got a proper team and enough case volume to justify the cost, for your first several years, though, you're using the network's compliance function, and that's exactly what it's built for. See, where self-employed brokers do get caught out is mistaking self-employed for unsupervised. Some new self-employed brokers assume that because they're not sat in an office with a compliance officer walking past them, the standards must be lower than that, but they aren't. If anything, they're actually higher because there's nobody standing over you making sure you're doing it right. The discipline has to come from you. That means running structured discovery calls, taking proper fact finds, documenting suitability properly, following the protection frameworks, saving everything into your CRM as you go rather than 3 days later, and treating every file as though it's about to be pulled, because occasionally one of them are going to be. And the self-employed brokers who are thriving long-term are the ones who treat compliance as a personal standard rather than an external one. The ones who don't, though, are the ones you eventually see quietly disappearing from this industry. And in terms of how often audits actually happen, it really depends entirely on the network and the firm. But a typical pattern would be a percentage of cases file checked every single month, and periodically a desk-based audit once, maybe twice a year. And then maybe a full compliance visit for the network's own review. You see new mortgage brokers pre-CAS get every single case checked, so audits feel constant. But post-CAS, that rhythm drops but never really disappears. And the FCA does periodic thematic reviews of the industry, which trickle down to individual firm audits. But the takeaway is really simple. If you're running cases cleanly, none of this is stressful. If you're cutting corners, it's a matter of when, not if, it's going to catch up to you. So if you're watching this and you're starting to realize that compliance isn't the scary bit of the career, it's actually the thing that makes you a better broker, then the natural question becomes whether the career itself is worth it in the first place. Because the compliance side, the sales side, the lifestyle side, the income side, the personality fit, all of it has to add up before you commit. And that's what this next video is all about. Is becoming a mortgage broker actually worth it? And it's my honest answer. It's the real income at each stage, the lifestyle, the genuine downsides, and the 3-question test that tells you honestly if this career is in your lane. Watch that one next and hit subscribe while you're there.